We're excited. With Dental Buying Network, our motto is better together, and individual pension plans is the perfect encapsulation of that motto and the perfect partnership. So we've got some gentlemen from Tower Wealth Advisory and from APP accounting firm. We're going to talk about some of the strategies, tax planning strategies, and saving strategies that are afforded by taking advantage of individual pension plans. Like I said, it's a perfect marriage with what we do here at the Dental Buying Network, we think. And so we're excited to hear what they have to say and maybe enlighten us on some of the ways that we can hopefully retire sooner and more wealthy. So, gentlemen, that's all I'm going to say. It's your turn.
Great. Thanks, Dr. Dave, for the introduction, and thank you, Gavin, as well, for hosting tonight. A big thank you to the people who are here on the call, taking time out of your evenings to sit down with us and learn a little bit about what individual pension plans are, whether they're useful to you, and if you can use them in your own wealth planning designs. So who's on the call tonight? Myself, Tyler Cobain, and you'll see Dave Cooper here as well. We're part of a team in Tower Wealth Advisory. So we're wealth advisors to affluent individuals in the Edmonton area who have, scattered across Canada. So we are working in many provinces now as our clients continue to retire. We also have Dwayne Pornichny on the call. He's a founding partner with APP and Associates, an accounting firm in Edmonton as well. So I'm going to do most of the speaking tonight and run through some slides with you guys on IPPs and what they are and how you can use them. So what are they, and are they right for me? I think I'm already sharing my screen. Gavin helped me set this up before we started our chat tonight. So our agenda tonight is to talk about the key advantages of an IPP, the considerations that you need to take into account when you're designing them, and who is an IPP candidate. And then if at the end of it, what now? Do we need to take things further from here? So individual pension plans are the most tax-effective registered retirement arrangement permissible under tax legislation. They're ideally suited for business owners, incorporated professionals, and highly compensated employees. IPPs allow for tax sheltering and accumulation of more registered assets through higher employer contributions than any other retirement vehicle available. And I made some notes here because I was kind of wondering, okay, I've been in this business for 20 years in the wealth management business, and I've been involved in IPPs that whole time. And I thought, when the heck did these things come into play? Obviously, they've been designed before my time because they've always been available to me. 1991 is when they actually started implementing IPPs or making them available. And they really came to be because at the time, people working in the public sector who were highly compensated were afforded more room in their defined benefit pension plans than what was available to individuals in private sectors. So like medical professionals with private or professional corporations. You guys and any other individual business owner couldn't save as much in their RRSP as an individual could save in the side of their pension plan. So there was the development of the IPP, and that IPP was launched back in 1991, and it was amazing. The federal government, agreed that business owners were treated unfairly and they needed to be evened out. So they developed the IPP plan. So that's kind of how it came to be back in 91. So an IPP can be a very powerful and flexible retirement savings tool for owner managers, especially those who are close to retirement with inadequate savings. The IPP allows the use of pre-tax corporate income to help catch up retirement savings. And I kind of want to key in on especially those who are close to retirement. That's one of the strategies that IPPs allow for, is when you've got somebody who's nearing their retirement, and if it's a dental practice, they're probably in the position where they're looking at selling their practice. Well, you all know what happens when you sell your practice. You're going to get a great big fat check received in your professional corp. And when you receive a great big fat check, CRA wants to come to your door and take a great big bunch of it as well. And when you develop an individual pension plan close to retirement, you end up creating a large funding requirement for the individual pension plan. It has to be topped up in the year that you create it. So if you create it in that year that you've sold your business, here's a great way for you to extract a whole bunch of money out of your professional corporation and get it into your personal hands. And once it's in your personal hands in that individual pension plan, it's then streamed out slowly in retirement as a monthly income to you. So it's a way to spread that tax burden out and hopefully access those funds in a lower bracket. So that's just one strategy. Now, IPPs are customized to provide better retirement funding than RSPs. In fact, IPP contribution room calculations include age as a factor. So as a result, IPP contribution rises with age, allowing employers to contribute more tax-deductible benefits. Consequently, these higher contributions allow for higher accumulation of compounding tax-deferred benefits for an IPP member. And I'm gonna pick on Dwayne right now as our accountant in the room. I talked to him a bit earlier today, and he has a great example of actually a dentist in his accounting practice that has taken advantage of an IPP, and he's got some numbers to kind of back this concept up. Dwayne, are you there?
Thanks, Tyler. Yeah, so just a very simplistic actually example of this is, let's say that you were able to make a maximum RRSP contribution this year if you chose the RRSP avenue in your retirement planning. The maximum contribution you would have been able to make for 2020 would be just a little bit over $27,000. However, if you had your own separate IPP set up, and this is a real example that I'm going to use of a dentist here in Edmonton that is in his early 50s and has an IPP set up, he is actually fortunate enough to contribute $34,000 in 2020 to his IPP. So you can see there's a real advantage just in this one little example of $7,000 where the dental professional was able to contribute an extra $7,000 in 2020 to their pension plan. And you know, when you take that $7,000 and kind of compound it over a number of years, because you know it does compound over the number of years, your pension plan will grow much more rapidly than an RRSP would, just because you're allowed to contribute that much more. So, you know, Tyler, that would be the example that I would want to share with everybody, is that you do have a real advantage with regards to IPP of accumulating that individual pension plan, much larger number, much quicker, rather than an RRSP.
That's great, Dwayne. And that's also an opportunity for you to extract a lot of money, more money out of your professional corporation and into your personal hands. That's a difference of your professional corp, correct?
Right, yeah. So unlike, you know, an RRSP that, you know, that's basically coming out of your own pocket, even though you do get the deduction for it, that depending on your professional corporation and what tax bracket it might be in, your professional corp actually makes the contribution on your behalf and gets that straight deduction within the professional corporation to lower your taxable income. So another little advantage from that perspective. And with that being said, you know, the professional corporation really is the professional. So it's something that you and your accountant or your professional accounting tax advisor would want to discuss to figure out the best plan for you with regards to how much money you need personally and what contribution that is going to come out of your professional corp, and to come up with the best tax savings plan for you and your professional corporation.
Great, thanks, Dwayne. I'll jump to my next slide. We're still touching on advantages here, and this is a nice bullet pointed slide that summarizes the vast majority of them. And so our first one here is, it's obviously, as we've just discussed, higher contribution room than an RRSP. And that contribution room increases with age. So the gap between what you can put into an RRSP and what you can put into an IPP widens as the years go on. So that difference between what could be saved up in an IPP versus an RRSP becomes quite substantial. Sizable contribution opportunity for past year's service upon implementation. So they're going to be looking at, these are actuarial firms that we'll have to engage with if we're setting up an IPP. They take a look at your past year's service, your past T4s, and they'll go back all the way to 1991 if they can go back that far, and look at what you made each year. And that's going to factor in and create how much room you have in your individual pension plan. So in the year that you created, it creates typically a very large funding requirement in the IPP. So it has to be pulled out of your professional corp and deposited on your behalf into your pension plan. Third point there, tax deductible employer contributions and administrative expenses. So this is a tax deductible contribution that's being made on behalf of the employee by the professional corp, and any administrative expenses that are incurred with the IPP are deductible as well. There's additional funding room available to replenish shortfalls. So if there is a year where perhaps your portfolio of investments in your individual pension plan suffers a market setback and you've experienced negative returns that year, you'll get your normal IPP contribution room. And in Dwayne's example, I think was 34,000 this year. Now, if your markets suffered and you have losses in your accounts, you're going to have a larger funding requirement in that pension plan. There's an actuarial calculation that's done each year to determine how much room can go into the IPP, or how much deposit can go into the IPP. And if it's been falling in value in the investment side, it's going to have to be funded. It's going to have to be topped up to get it to the correct funding amounts. So this is an additional opportunity to fund up and get money out of your professional corp. There's additional tax deductible contributions that can be made at retirement. It's like the termination of the IPP plan, or at the end of the pension plan, there could be additional room that could be used. There is also income splitting capabilities at age 50. So if you start drawing your pension at 50 and beyond, you can split your pension with your spouse, which is great tax planning opportunity in retirement, a way to divide the income in the household. And it's a survivor pension is included. So if you are the individual pension plan member and you pass away, it is passing on to your spouse at death. It also says here that estate and succession planning opportunities exist. And that's true because if the spouse now passes away, that money is now directed through your will and to your estate. So to your kids, to your grandkids, whoever it might be. It doesn't stop with the spouse. It continues to be passed on. Third to the end there, customizable tax sheltering strategies. What we're referencing there is that this is an individual pension plan, and therefore the portfolio of investments in that plan is unique to you. So you usually would end up engaging with guys like myself and Dave, and we'd be building a portfolio of investments for you to manage inside of that pension plan that's unique to your risk tolerances. Post-retirement cost of living adjustments are factored in. That means it's factoring in cost of living adjustments, inflation. So every year when the actuarial calculation is done, if inflation has been extremely high, that may increase your room that's available to be deposited into the IPP, because it has to fund and prepare for that cost of living factor. And it's got better creditor proofing. Part of that is really in regards to getting the money out of your professional corp, moving it away from any potential liability there, and getting invested in a pension plan in your personal hands. So those are some of our key advantages. Now, some of the considerations that you'll want to look at when deciding whether or not you want to put an IPP in place is an RSP and an IPP can't exist together. These two things have to be melded together. So if you're opening up an IPP, your RSP has to be rolled into the IPP. So you can see that in the first bullet point there. RSP transfers may be required to fund past service. So if you have an existing RSP, it ends up getting transferred into the IPP. That's done without any tax implications. It's a direct transfer between registered plans. But there is really only one plan going forward then, and it would be the IPP. So I mentioned that there in the second point. So third point, no access to funds while employed and a member of the plan. No different than a defined benefit pension plan that you run into in the public sector. They can't go and pick money out of their defined benefit pension plan. It's the same in an IPP, it's locked in there. For plans that require to be federally or provincially regulated, there are minimum contribution requirements to the company. Pretty much across Canada, OSFI, which is the Office of the Superintendent of Financial Institutions, they oversee pension plans in Canada. And so they help to determine what a pension plan needs to have inside of it in order to be correctly funded. And so they oversee these plans. Your actuarial firm will provide your calculations to OSFI so that it is approved each year. Plan assets must be used to provide a pension. As such, the benefits are locked in. We kind of touched on that already. If assets are doing well and an excess actuarial surplus exists, this may affect your company's ability to make contributions. So if the reverse is true, and let's say you guys were brilliant in January in the beginning of the month and bought GameStop, and it went up 1,600% in your pension plan, and you decided to get out at that point, you're going to have a massive pension plan at that point, and you're not going to be able to fund it the way you would have wanted to in the past. So keep that in mind. But I don't think you'd be crying too much if you got out of GameStop at the right time. Final point there, higher investment standards exist for IPPs. This is to ensure quality and diversification of the plan assets. So again, this is referring back to OSFI and that federal institution that oversees pension plans. They make sure that they're being properly managed. And then you would be working with your investment team to determine what investments can fit in there. Next slide here is who is an IPP candidate? So IPP candidate is typically feasible, or sorry, an IPP is typically feasible and certainly worth considering for business owners, incorporated professionals, medical professionals, key executives, and key employees that are highly compensated. So some questions to ask would be the following. Are you at least age 40? So this is where IPPs start to gap out between RSPs. And RSP has a maximum contribution limit of 18% of your income, up to a maximum of about $27,200 this year. IPP has got a 20% limit at age 40 in terms of what it can, what can be deposited into it. And that maximum limit on it is what Dwayne mentioned earlier, $34,000 contribution. So that gapping starts to happen at age 40. Does a bona fide employer-employee relationship exist? So this is an indication that we need to have your professional corp and you as the employee receiving T4 income from your PC. That relationship has to exist. It's not that you can go out and put your nephew on an IPP program. It has to be a bona fide relationship. So again, noted there, third point, does the employee receive T4 income? And does the employee want registered retirement savings that exceed RSP and other registered plan limits? If you're not going to contribute over and above what could go into an RSP, there's no point in doing this. It's too much effort on your behalf to implement something like this. And final point, does the employer want larger deductions than an RSP can provide? This is, again, your professional corp. And like Dwayne said, the professional corp is the professional. Do you want to get more money out of your professional corp into your personal hands? You know, typically in your guys' case, I'm assuming that's a yes, but it's not always the case. So if you want more contribution room than what your RSP can provide, IPP is a great solution for that. So how can Tower Wealth Advisory help? So Dave and I are certified financial planners and discretionary portfolio managers. And at Tower Wealth, we're trying to provide comprehensive wealth advisory solutions for affluent individuals and business owners using our unique wealth navigation approach. So it's our goal to provide clients with a one-of-a-kind experience and bring their visions to reality. And it's our belief that business owners, professionals such as yourselves should work with a network of professionals who work together to provide the best financial, tax, and legal advice. So as wealth advisors, it's our job to try and coordinate solutions involving your tax, investment, insurance, and estate planning needs. And I key in on that working together thing because I know the success that we've had in our business is because we try and quarterback a lot of the questions that the clients give to us. Instead of them reaching out to a lawyer and an accountant and an insurance professional and trying to tell their story to all of those professionals, it can be confused. The message can be lost between teams. And so what we want to try and do is bring those teams together so that we're all working towards getting the right solutions in place for the client. So our job in the IPP realm is to have a conversation with you about, you know, what your investment savings, what you want them to look like, what you need or want to pull out of your professional corporation, and what you want to create in terms of a retirement plan. We help craft that for you, and an IPP is just one of the tools in our belt, I guess, that we could use. Now, working with professionals kind of leads me into Dwayne's firm. Just a quick blurb about Dwayne. You've heard a little bit from him today. He works with a number of professional corporations in his practice, and he's somebody that we've worked with closely on a number of client cases. So again, this is an opportunity for us to work jointly with professionals who are different from us in different avenues, but providing custom tailored solutions to the end client. So this is kind of where we wrap up our slides, and we'd be happy to discuss IPPs in greater detail with you guys. And maybe there's some questions on after the brief presentation that we've had here. Today's presentation was designed to be, 1,000 feet up, looking down at what an IPP is and just kind of getting a feel for what it might, how it could work for you. These are individual pension plans, so they're very unique to the individual. They're very specific around what that individual's previous work history has been like. And that's what's designing the future needs inside of that plan. So that's my formal presentation up to this point, Gavin. I don't know if you're seeing any questions pop up there on your side or anything that we need to address.
Yeah, there's a few questions for sure that's come in. If you're ready, I'll go ahead and start asking you.
That'd be great.
One question that came in is, what is the cost to manage an IPP?
That's a great question. There is ongoing costs to setting these up, which are tax deductible to the PC. I think Dave Cooper, my partner there, has a sheet in front of him that has some examples of what the fees look like here. Dave?
Yeah, typically it's really an administrative cost. Part of managing the IPP is that you were required to have an actuarial or a pension consultant, same thing, administer the plan. So typically They all charge a bit differently. Some charge you a lump sum up front to implement your plan, and then an ongoing annual charge. And then usually there's a 3-year charge. You have to do a triannual actuarial calculation. Other firms just basically make it a one price annual cost, and that includes all of your implementation and things like that. So when you're looking, for just a straight annual cost, it's about $1,300 to implement and manage your IPP. Other costs that you would incur would be kind of typical of what you would be paying to manage your investments as well, whatever the cost of your RSP fees might be. So those would be the $1,300 for your IPP administration would be over and above what you're paying for your advisory fees.
Thanks, Dave. Thanks for answering that question. Another question that came in was, how would I implement an IPP?
Yeah, great question. Basically, you have to go through a few steps. So typically when we have someone come to us that is looking for an IPP or is considering one, obviously based on what Tyler's discussion was, we want to make sure that you're an ideal candidate. Once we establish that, we would get in touch typically with your CPA, your accountant. So we talk to someone like Dwayne and discuss the use of the IPP for you as a client. And at that point, if it made sense to move forward, we would then try and obtain as much of your T4 information as far back as you were receiving T4 up to, like Tyler said, 1991. And then once we have that data, we would go to an actuary with just the basic data as far as kind of your age, amount of T4 income you've had over the years, and your current RSP balance. And we'd submit that. And they'd give us a ballpark quote as to how much you could roll into an IPP, how much you can contribute in the future years, and then we'd sit down and discuss that with the client. So once we get to that stage, if everything's still a go and everything makes sense, then we formally would ask the actuary to prepare the documents to implement an IPP. And sometimes it'll take a couple weeks, and then it'll take some time. It goes to CRA to get a pension number, and that could take a month or two, depending on the time of year. And then once you get officially registered with CRA, that could be another month or so. So it's a bit of a process. And once that's up and running, it's a lot easier to manage on an annual basis, but it does take a bit to get set up.
And so if you were thinking of using it this year and not doing your RSP top up, there's not enough time for that. Do your RSP top up and start working on your IPP. And then the RSP rolls into the IPP. So it's not like you lose that RSP room or anything like that. It's melded together with what the room is that you have in that individual pension plan.
Thank you for the explanation, guys. Question that came in was, how could capital loss inside IPP be carried over?
It's a good question. It's the same as an RSP. The capital loss is just that. You can't write it off. You can't deduct it now. Tyler did touch on that. Because your pension amount that you're contributing every year is because you need to have a specific future value to provide the pension income in retirement that's been calculated at the very beginning of the plan based on your income. So if the value of your pension, your IPP falls, you're going to be set up with an increased amount that you can contribute into that IPP to make up that shortfall. So in a roundabout way, you can put all the money you want into it, and if it falls dramatically, you're going to put a lot more money in. So as Tyler said, it's better to grow it quite significantly, and maybe you'll get a bit of a contribution holiday. Now, that's not good for a tax deductibility point of view for your corporation if that's what you're after every year, but it is balanced out that way. So, I can tell you just in a kind of funky way how this would work is if you haven't done so well with your RSPs and you've lost money on them, if you go to implement an IPP, it's going to require a pretty big number. And if your RSP number is a little short, you're going to be allowed to make a large contribution to make up that shortfall inside of your IPP. So in a roundabout way, you can make up your loss by contributing more, whereas in an RSP, you're not afforded that opportunity to make up what you've lost.
Thanks, Dave. Thank you. Another question that came in is, does the IPP room add up every year, even if someone does not have an IPP?
Correct. So just based on your age, when we go and get a quote, it's always based on your current age, your years of service with your own company, employer, your T4 income. And that's how we calculate it. So if you start one at age 40, you're going to have a much lower number that you can roll over into an IPP, and you'll have also a lower contribution amount. As you're, in the 60s and you're trying to start one, you're going to have a much larger rollover that's available, and your contribution limit's going to be much higher.
Got it. Got it. Okay, let me move on to another question here. Why haven't I heard of these before? Why do you think my accountant isn't more excited about IPPs?
I guess it's one of those things that's as advisors, we can kind of lay out a really big menu of items to do, and the more complex they get, the more everybody decides to run for the hills. So this is one of those where you think of people who work for a public service or the government, and they have these nice defined benefit pension plans. Well, essentially, this is what you're doing: is an IPP is a defined benefit pension plan, but just for you. So you have to administer your own plan. And I don't mean you personally, but you have to put all the pieces in place to have this plan administered. So it's a bit more complex. It's a bit more restrictive, as Tyler said, than an RSP, because you just can't go pull money from it when you're running short this year or the next year. You always have to make a contribution. So if you're in a year and your contribution room for that year, and this is not really a contribution room, it's you have to make $37,000 addition to your IPP, and it's been a bad year in your corporation and you don't have the money, you're going to have to apply to get a little bit of a break, and it's going to have to be made up at a later date if they approve it. If not, you run danger of a collapsing plan and things of that nature. So an actuary will always kind of keep you in line with that, but there are a little bit more restrictive, and that's why people don't like it.
Thank you. Thanks again, Dave.
Actually, Gavin, can I just echo in on that? Being the accountant or the CPA, Dave does pick up on a very good point that it is an individual pension plan. So while some accountants may not like to refer them to an existing professional to use, they are really individualized. So you really need to look at it on an individual basis and not have an all-encompassing thought process behind it. So I can tell you, we deal with a number of medical and dental professionals, and in some cases the IPP would work great, and so we have that conversation with the professional. In some cases it may not work great for various reasons based on that individual situation. And so then we generally wouldn't have a discussion about it because there would be not necessarily any upside for them. So you really got to look at the individual, the situation that they're in, their professional corporation is in, to make that determination whether or not you should look at an IPP. They're easily forgotten, and they shouldn't be, because as Tyler mentioned, once you hit kind of the age 40, IPPs start to make some sense, especially if you're achieving some decent income levels. So I just wanted to chime in from the accountant's perspective, if you will.
Oh, no, thank you. Always welcome, Dwayne. Thank you so much for adding to that. Another question I saw was, is it an either or situation with RRSP? Sorry, you might have already answered that, but is it an either or? Is it an either or situation with RRSP?
It is and it isn't. So in the sense that once you establish an IPP, you will no longer have contribution room available to put into your RRSP. So you have to roll your RRSPs into your IPP, and therefore all future contributions now go into your IPP. So the only time you're still going to manage an RRSP is if your IPP rollover states that you need to inject $500,000 of your RRSP into this IPP, and you have $600,000 in your RRSP, you're still going to have $100,000 RRSP left over. You just won't be adding to it. But we don't see a lot of that. Typically, people are short and they need to make up the difference.
Right.
Yeah.
Okay. Got it. I'm sure that answered their question. If anyone has a follow-up question, feel free to put it into the chat room. Another question that came in is, why would someone start an IPP at age 40 versus 60 when there is more rollover room later on?
You know, it's because of the age. If you start an IPP at 40, you're basically making that rollover room up over, you know, the time from 40 to 60. Your contribution limit to the IPP is higher than the RSP. So you're kind of chiseling away that big rollover amount that is possible by rolling it into the IPP at 60. So it's just a matter of, if you leave it for a long time, you're going to have a bigger amount that you have to make up. If you start the IPP earlier, it's going to close that gap over time. So, you know, in a great planning world, you've heard this presentation, you're a year away from selling your practice and you've never done this. Well, hey, your timing's perfect, because then you'll be able to find a way to roll over the biggest lump sum possible, with a possibility for maybe even a top up over and above that rollover as some terminal funding. So there are opportunities to really move a lot of money, but, you know, just like most things in planning and life, you don't really kind of hold on to things to wait for 20 years and decide I want the big rollover, because what happens if the government changes the rules? All sorts of things can happen. So
It's a good point. No, that's a good point. Thank you.
I was just going to chime in there too, Dave. I'm thinking that question is probably the individuals looking at it going, well, why don't I wait till I'm 60, implement an IPP when I'm selling my practice, and have that available to now extract a bunch of money from the sale of that practice.
Yeah.
And everything that Dave said is valid. If you're starting at 40, you're chipping away at the big chunk that's going to be available to you to deposit at the end of, at age 60, if that's the age. I guess the only other advantage of starting early, if you're 40 now, would be you're chipping away at that amount and you're investing in a tax sheltered portfolio. So if there is growth in there, you're not having to pay tax every year on the growth, the income on that, off of that investment. So you're going to compound grow that investment quite a bit. So if you wait until 60 to make your deposit, you're going to have more in there if you've been depositing for 20 years, just due to the growth on your portfolio and not having to pay tax on it in that amount of time.
So correct. Yep.
Got it. Thanks for another perspective on it, Tyler.
Yeah.
So how does income splitting work?
Yeah, so typically income splitting is something that the government allows on your pension income. So for somebody who isn't a member of a bigger just a defined benefit pension plan at all, if you've always done RSPs your whole life, you retire at 55 or 60, and you start drawing your RSPs out as a RIF, a registered retirement income fund, that income that's derived from the RIF is your income. If you're married, you can't roll some of that registered retirement income fund to your spouse until 65. So if you're a regular old person with RSPs and no pension plan, you can income split your pension income after age 65. If you're a member of a defined benefit pension plan, or in this case, an IPP, you can start that income splitting at age 50, which is a real big advantage that, you know, in my personal belief, maybe the government should look at some rules on that income splitting issue when it comes to allowing defined benefit plan members to have a better and easier way of income splitting than the rest of Canadians to have.
Right. Okay. Next question is, are there group pension plans that are out there, and how do they compare, pros and cons?
I guess when you look at a group pension plan, we would think in the terms of a defined benefit plan. So if you're an employer with more than a few people who are going to join, so if you're starting this defined benefit pension plan from scratch for a group of 10, you're creating kind of in a sense a group plan, and it wouldn't really fall under the IPP legislation. You'd be as an employer or a company creating a company pension plan for all the members to participate in. So that's the only other way from a group perspective, I think you would look at that. So advantages, disadvantages, if you're looking at that for a larger group, well, as an individual pension plan, the plan's going to be designed to maximize what you can put into that pension. If you're running a defined benefit plan for a group of people, you might not run everything to the max numbers. You might provide a benefit that's not going to be as robust as you're going to provide a benefit for yourself in an IPP. So, and cost. The cost of running a DB plan, because it's significant. We manage a pension plan in the north, and they're into the $100,000 plus a year of pension actuarial costs just because of the sheer volume of members. Because if you think about it, every member's personal contribution amounts and what their benefit's going to be is calculated individually, and that you multiply all your costs out by the amount of members that you have.
Right. No, that makes sense for sure. I'm just checking if there's any new questions here. A lot of them are very similar to what was asked and answered already. Anyone has any other questions that they want to pose, this is the best time so we can get it in and everyone can benefit. All of the questions and answers are going to be part of the recording and available on the Dental Buying Network website. So thanks everyone for their great questions and engagement and comments, and thank you Tyler, Dave, and Dwayne for all of your great insight and great advice. Just double checking that I didn't miss anybody. Looks like all of the questions have been answered, but if anyone wants to reply to the Zoom invite and confirmation emails, that will go to me, and I'll make sure it gets to the right team, right advisor, and again, answer for you as soon as possible. If Dr. Dave, if you have anything to add or any closing remarks on behalf of Dental Buying Network, now's a great time.
No, just really grateful for you guys for that informative presentation, and it wasn't something that I knew very much about, but I was actually been thinking about for a long time, so I learned a lot of things, and that's actually really good. So we appreciate you coming on and showing this to members of our network, and hope they all got something good out of it too.
I hope so too, and thank you for inviting us to speak.
No, it's our pleasure to have you. You're invited back anytime, and thank you so much, everybody. Have a great night, and we'll see you next time.
Go Oilers.
Go Oilers. I just slipped that in there.